Most financial advice fails in a quiet way, not because it is malicious, not because it is intentionally misleading, but because it is designed to explain behavior, not outcomes. That difference seems small, but inside a financial system, it changes everything. Most financial advice sounds correct the first time you hear it. Spend less than you earn. Save consistently. Avoid unnecessary debt. Invest for the long term. None of these statements are wrong. They are logically clean, easy to understand, easy to repeat, easy to teach. And that simplicity is exactly why they spread. Simple rules create psychological comfort. They reduce complexity. When money feels confusing, people look for rules that make the system feel manageable. Financial advice provides those rules. It creates the impression that the system is understandable. Follow the rules. You will be fine. If you are not fine, then something must be wrong with your behavior. This is where the narrative quietly forms. Success becomes a reflection of discipline. Struggle becomes a reflection of personal decisions. But the financial world does not operate inside simple rules. It operates inside systems, and systems introduce forces that advice rarely explains. Inflation slowly reshapes the value of money. Asset prices move independently of wages. Tax structures reward some behaviors while punishing others. Capital moves through markets in ways individuals cannot control. These forces operate constantly in the background. Most people never see them directly. What they see instead is advice. Advice sits on the surface of the system. Clean, simple, comforting. But surface rules can feel correct while ignoring the structure underneath. Saving money is responsible. But saving money inside a system where purchasing power declines every year is not the same thing as building wealth. Working hard is admirable, but labor income behaves very differently from asset ownership over long periods of time. Avoiding debt sounds cautious, but in certain environments, leverage becomes the mechanism that allows people to acquire appreciating assets. The advice itself does not change. What changes is the system surrounding it. And when the system changes, advice that once worked can quietly stop producing the same outcomes. This is where confusion begins. People follow advice that sounds responsible. They save, they budget, they avoid reckless spending. Yet, over time, the results do not match the promise. The gap between effort and outcome slowly appears. At first, it feels personal. Maybe the savings rate wasn't high enough. Maybe the discipline slipped somewhere. Maybe the strategy simply needed more time. So the solution becomes more of the same advice. Save more. Cut more expenses. Work harder. But repeating behavior does not change the structure surrounding it. And this is where the deeper problem begins to appear. Most financial advice is built around individual behavior, while the outcomes people experience are largely shaped by the system itself. Financial advice almost always your habits, your spending. The message is simple. If you behave correctly with money, your financial life should gradually improve. Spend less than you earn. Save consistently. Invest patiently. These ideas frame money as a behavioral problem. If the outcome is good, the behavior must have been correct. If the outcome is disappointing, the behavior must have been flawed. This interpretation feels logical, but it quietly ignores something important. Money does not exist only at the personal level. It exists inside an economic structure. That structure moves continuously. Interest rates rise and fall. Housing markets expand and contract. Currencies lose purchasing power over time. Asset prices inflate. These forces operate whether an individual behaves responsibly or not. They are not controlled by discipline. They are shaped by the design of the system itself. This is where the gap between advice and reality begins to appear. Advice focuses on personal decisions, but financial outcomes are heavily influenced by systemic conditions. Consider something simple: saving money. Saving money is responsible behavior. It creates stability. It creates flexibility. It creates a buffer against unexpected events. But inside an inflationary system, saved money slowly loses purchasing power, year after year, quietly. The behavior is responsible, but the system reshapes the result. The same pattern appears in other areas of financial advice. Working harder increases income, but wage growth often moves slower than asset inflation. Over long periods of time, housing prices, equities, and other assets can rise faster than wages, which means labor alone struggles to keep pace with the system. Again, the behavior is not wrong. Working hard is productive, but the structure surrounding that labor determines how far the income can actually go. This difference between behavior and structure is rarely discussed in everyday financial advice, because behavioral rules are easier to communicate. They fit inside short sentences. They sound responsible. Structural explanations are more complicated. They involve economic incentives, market dynamics, institutional behavior, long-term financial cycles. These forces are harder to explain in a simple rule, so they are often left out entirely. The result is a form of financial advice that is technically correct, but structurally incomplete. People are told to improve their habits, to reduce unnecessary spending, to increase savings. But very little attention is given to the environment those habits exist inside. For example, asset ownership behaves very differently from wage income. Assets participate in market appreciation. Labor income typically grows slowly and requires constant effort. Over time, this difference compounds. Those who own appreciating assets benefit from the system's expansion. Those who rely only on wages often experience a slower form of financial progress. None of this means discipline is irrelevant. Responsible behavior still matters. But behavior alone cannot fully explain financial outcomes, because the system surrounding that behavior is constantly reshaping the results. And once that becomes visible, the way financial advice is interpreted begins to change. Advice that once sounded complete begins to reveal the structural layers it never mentioned. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Financial advice also carries another quiet assumption. Most common financial rules were shaped during specific economic periods with different conditions, different asset prices, different relationships between income and cost of living. Advice travels through time, but the system does not stay the same. Decades ago, a single income could often support an entire household. Housing prices were lower relative to wages. Education costs were far smaller. Saving a portion of income and gradually investing it could create meaningful financial progress. The environment supported that strategy. But systems evolve. Housing markets expand. Urban populations grow. Asset prices inflate. Currencies lose purchasing power. And when these structural changes accumulate, the environment surrounding financial advice begins to shift. What once worked smoothly inside the system may begin to behave very differently. Consider housing. In many places, Housing prices have grown faster than wage growth over long periods of time. This creates a widening gap between labor income and asset ownership. A rule like save patiently for a home can quietly become harder to execute as prices accelerate faster than the ability to accumulate savings. The advice itself has not changed, but the system surrounding it has. The same pattern appears with education. Higher education was once a relatively modest financial commitment. Today, the cost structure has expanded dramatically in many regions. Advice like invest in your education remains logically sound, but the financial equation behind that decision has become far more complex. Debt levels, expected income, economic demand for certain fields, all of these variables shape the outcome. Yet advice often remains frozen in older assumptions. It continues to present the system as if the underlying conditions have not moved. This creates a time mismatch. Advice designed for one economic environment gets applied inside another, and over time, that mismatch becomes more visible. People follow rules that once worked, but the results begin to feel different, slower, more uncertain, harder to achieve. This is not necessarily because individuals are behaving incorrectly. It is often because the structure surrounding their decisions has changed. Financial systems evolve through policy changes, market expansion, technological shifts, global capital flows. These forces reshape opportunity over long periods of time, but everyday financial advice rarely updates at the same speed. It continues repeating familiar rules. Spend responsibly, save diligently, invest over time. All reasonable ideas, but ideas that assume the surrounding environment behaves the same way it once did. When the system evolves faster than the advice describing it, confusion naturally follows. People begin to feel that they are doing the right things, yet the progress feels slower than expected. The explanation often returns to personal discipline, but discipline is only one variable. The structure of the system itself is the other. And when the structure shifts, advice that once felt reliable can quietly begin producing very different results. At this point, the question becomes clearer. If the advice sounds responsible, and the behavior is not necessarily wrong, why does the outcome still feel misaligned? The answer often sits in a quiet distinction. The difference between advice that sounds responsible and strategy that actually works inside a system. Financial advice is usually built around behavior. Spend less, save more, avoid mistakes. These ideas focus on stability. They help people avoid obvious financial harm. But stability is not the same thing as progress. And progress inside financial systems tends to follow a different set of dynamics: ownership, scale, compounding. These forces operate very differently from simple budgeting rules. Budgeting protects resources. Ownership multiplies them. Saving money preserves value in the short term, but ownership allows capital to participate in the growth of the system itself. This is the structural shift that most advice never fully explains: the difference between protecting money and positioning money inside systems that expand. Economic systems constantly generate value through businesses, markets, and assets. Equities appreciate as companies grow. Real estate appreciates as cities expand. Infrastructure produces ongoing cash flow. When individuals participate in these ownership layers, they are no longer only protecting income. They are participating in the system's expansion. This is where the conversation quietly changes. Financial advice built only around discipline treats money as something fragile, something that must be protected from mistakes. Strategy, on the other hand, treats money as something that can be positioned, placed inside structures that grow over time. This does not eliminate risk. Every financial system carries risk, but it changes the role money plays. Instead of simply managing consumption, the focus begins to shift toward participation in economic growth. And this is where the limits of traditional financial advice begin to show. Because most advice is designed to help people behave responsibly with money, not to explain how financial systems actually distribute wealth. Understanding the system requires a different lens. It requires looking beyond individual behavior and asking deeper questions. Who owns the assets? Where does capital flow? What incentives shape the market? Once those questions become visible, the advice itself starts to look different. Not necessarily wrong, but incomplete. Saving still matters. Discipline still matters. Avoiding reckless decisions still matters. But those behaviors alone do not explain why wealth accumulates in certain places within the system. That accumulation follows structural patterns, patterns driven by ownership, leverage, incentives, and time. And seeing those patterns changes the way financial advice is interpreted. Advice becomes a starting point, not the full explanation. Because understanding money ultimately requires something deeper than simple rules. It requires understanding the system those rules operate inside. The system does not reward behavior alone. It rewards positioning. And once that becomes visible, financial advice begins to sound very different. If this changed how you see the system, subscribe. Like this if it clarified something. A bigger paycheck feels like progress. You work harder, you gain experience, you earn a promotion or negotiate a higher salary. The number on the paycheck increases. At that moment, it feels like you have solved something. Financial pressure seems lighter, bills feel easier, the future appears more stable. For a while, this feeling is real. Higher income does improve your position. It gives you more room, more flexibility, more options than before. But over time, something begins to happen quietly. The larger paycheck stops feeling large. The relief fades, and the same financial pressure slowly returns. This is the illusion at the center of the paycheck trap. People assume the problem was the size of the paycheck, but the real issue is the structure surrounding it. Income operates inside a cycle. Work produces money. Money supports life. Life creates obligations. Those obligations require continued work. When income rises, the cycle doesn't disappear, it expands. A higher paycheck often leads to a slightly larger life, a better apartment, a newer car, more comfortable travel, more spending that once felt out of reach. None of these decisions feel reckless, they feel deserved. You worked harder, you earned more. Improving your lifestyle seems like the natural reward. But each improvement quietly resets the system. Expenses increase, expectations rise, and the new income becomes the new baseline. The paycheck that once felt like progress becomes required just to maintain stability. Suddenly, the larger salary is no longer creating freedom, it is maintaining the structure that grew around it. This is why the pursuit of a bigger paycheck can become a trap, because it feels like movement, it feels like advancement. but the underlying structure stays the same. You still trade time for income. Income still supports obligations. Obligations still require more time. The cycle resets again. And each time the paycheck grows, the cycle often grows with it. The numbers change. The structure does not. This is why many people who once dreamed of a certain salary eventually reach it and still feel financially constrained. From the outside, their income appears impressive, but internally, most of that income is already committed. Housing, transportation, lifestyle maintenance. Financial gravity increases alongside income. The paycheck becomes larger, but so does the system surrounding it. And when the system grows at the same speed as income, progress becomes difficult to feel because the gap between earning and obligation never truly widens. This is the quiet beginning of the trap. The belief that the next paycheck increase will finally fix the problem. The belief that one more raise will finally create freedom. But if the structure remains the same, the system will continue behaving the same way. Work produces money. Money maintains life. Life demands more work. The paycheck grows, the cycle continues. And the person inside the system begins chasing the next increase, hoping the next number will finally change the outcome. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Once someone begins chasing a bigger paycheck, the strategy seems obvious. Earn more. Move up. Increase income every few years. From the outside, this looks like progress. A higher salary, a larger title, more responsibility. The numbers continue rising. But inside the system, something subtle begins to change. Each increase in income raises expectations. Not only your expectations, the expectations of your life. Housing improves, transportation improves. Your environment begins reflecting the new income. What once felt like luxury slowly becomes normal. This shift is quiet. It does not feel like a decision. It feels like adaptation. When income rises, lifestyle quietly rises with it. The new apartment feels justified. The better car feels reasonable. The upgraded routine feels deserved. None of these changes appear reckless. Each one feels like a natural extension of progress. But together they reshape the system. Every improvement introduces a new baseline, a higher monthly cost, a larger financial structure to maintain. The paycheck grows, but the system surrounding the paycheck grows at the same time. This is where the trap begins tightening, because once the structure expands, it becomes difficult to reverse. The nicer apartment becomes the standard. The car payment becomes normal. The upgraded lifestyle becomes expected. Soon, the larger paycheck is no longer creating freedom. It is maintaining the new structure. Financial gravity increases. More income becomes required just to sustain the life that formed around it. This is why many high earners still feel financial pressure, not because they failed to earn enough, but because the structure expanded alongside their income. When expenses grow at the same pace as earnings, the gap never widens. Income increases, but financial flexibility remains the same. The system resets, again and again. The person inside this cycle begins believing the solution is another increase, another promotion, another jump in salary. Because the last increase helped for a moment, so the next one should finally solve it. But if lifestyle continues expanding with income, the pattern will repeat. Each new paycheck increase will feel like progress at first, then slowly become the new baseline. The trap is not the paycheck itself. The trap is the belief that income alone changes the structure. Income improves comfort, but comfort can quietly reinforce the cycle. More comfort often leads to more commitments. More commitments require more stability. More stability increases dependence on the paycheck. And dependence is what keeps the cycle intact. Because once life requires a certain level of income, risk becomes harder. Investing becomes harder. Waiting becomes harder. The person begins protecting the paycheck instead of escaping the system built around it. This is why chasing a bigger paycheck often feels like forward movement while leaving the structure unchanged. The numbers increase. The system remains the same. Work produces income. Income supports the structure. The structure requires continued work. Until something changes, the cycle will continue repeating. Not because the paycheck is too small, but because the strategy never moved beyond it. The real problem with chasing a bigger paycheck is not the paycheck itself. It's the strategy behind it. A paycheck is income. Income is temporary. It arrives, it gets distributed. Then the cycle begins again. Work produces money. Money supports life. Life creates obligations. Those obligations require more work. The system resets every month, every year, every promotion. When someone spends their entire strategy pursuing a larger paycheck, they remain inside this same loop. The numbers grow, but the structure remains unchanged. Income improves the cycle. It rarely transforms it. Because income is fuel, not the engine. Fuel enters the system and disappears. The engine is what creates momentum. Ownership is the engine. Ownership behaves differently than income. Income must be earned again and again. Ownership continues producing value after the initial effort. Assets remain, assets grow, assets produce returns, and those returns begin producing additional returns. This is where the system finally changes. Income stops being the only source of progress. Ownership begins carrying part of the weight. That is when the cycle stops resetting. The person still works, but now the paycheck is doing something different. Instead of maintaining the structure of life, it begins building something that expands beyond it. Income becomes capital. Capital enters ownership. Ownership compounds. Compounding creates acceleration. Acceleration is what the paycheck alone can never provide. Because effort grows linearly. Compounding grows exponentially. This is why many people spend decades chasing larger salaries and still feel financially stuck. Not because they failed to work hard, because the strategy never moved beyond the paycheck. The paycheck was always meant to be the beginning, the fuel that allows you to build ownership, not the destination itself. Once income begins building assets instead of only supporting lifestyle, the system starts behaving differently. The cycle loosens. Financial gravity decreases. Progress begins stacking instead of resetting. And over time, something subtle happens. Work is no longer the only engine of movement. Assets begin producing momentum on their own. That is when the trap finally breaks. Not because the paycheck became larger, but because the strategy finally moved beyond it. If this changed how you see income and strategy, subscribe. Like this if it clarified something. Most people believe they understand where their money goes. You earn it, you spend it, it disappears. Rent, food, transportation, bills. At the surface, the explanation feels simple. Money enters your life, and then it leaves through expenses. But inside an economic system, money rarely disappears. It moves. Every dollar that leaves your wallet continues traveling through the system. It becomes someone else's revenue, someone else's income, someone else's capital. Spending is not just consumption. It is the first step in a financial chain. Consider something ordinary, buying a meal at a restaurant. At the surface, the transaction seems straightforward. You exchange money for food. The money is gone. But inside the system, that money continues moving. Part of it becomes the restaurant's revenue. Part of it pays the staff. Part of it covers the cost of ingredients. Part of it goes to suppliers. Those suppliers then pay their workers. They purchase materials. They pay transportation companies. The same dollar begins circulating through multiple layers of the economy: businesses, workers, producers, distributors. Every transaction pushes money deeper into the system. The process continues far beyond the original purchase. Companies reinvest profits. They expand operations. They borrow capital to grow. Investors fund those expansions. Banks finance those loans. Financial institutions manage the flow of capital. What began as a simple purchase becomes a chain reaction inside the economic structure. This is the first thing most people never see. Spending is not an ending. It is a redirection. Money moves from individuals into businesses, from businesses into wages, from wages into new spending. The system depends on this circulation. If money stopped moving, economic activity would slow immediately. This is why economies are often described as systems of flow. Money travels constantly between households, businesses, and financial institutions. But individuals usually only see their part of the movement. Income arrives, expenses remove it. What remains invisible is the path money takes afterward. Once it enters the system, it begins moving through structures designed to keep capital circulating. Businesses reinvest. Banks lend. Markets expand. And every one of those structures quietly channels money toward new destinations. Understanding this movement changes how spending is interpreted, because money rarely disappears. It simply continues traveling through a system far larger than the moment where it left your hands. After money moves through path, debt. Most people think of debt as something personal: a credit card balance, a car loan, a mortgage, something owed, something that must eventually be paid back. But inside the financial system, debt plays a much larger role. It moves money forward in time. When a bank issues a loan, the money being used often did not previously exist in that exact form. Credit expands the supply of money circulating through the system. That credit allows individuals and businesses to spend today using future income. Homes are purchased, businesses expand, infrastructure is built. Debt accelerates economic movement. It increases the speed at which money flows. A mortgage does not simply transfer money from a borrower to a seller. It activates an entire financial chain. The bank issues the loan. The borrower purchases the property. The seller receives the funds. Construction companies build new housing. Suppliers provide materials. Each stage redirects capital through additional layers of the economy. But debt introduces another mechanism as well: interest. Interest is the price paid for using money over time. Borrowers receive capital immediately. Lenders receive a return as the debt is repaid. Over years, this interest becomes a steady financial current flowing back toward lenders and institutions. Mortgage payments move toward banks. Credit card interest moves toward financial companies. Corporate debt payments move toward bondholders and investors. This creates a long-term redistribution of money. Small monthly payments accumulate into large streams of capital moving through the financial system. And because debt exists everywhere in modern economies, homes, cars, education, business expansion, government financing, the flow of interest becomes one of the largest financial movements inside the system. Every payment made on a loan quietly redirects money through institutional structures, banks, bond markets, investment funds. These institutions collect and recycle that capital. They lend again. They invest again. They expand credit again. The system grows through this cycle. Borrow, spend, repay, borrow again. Debt does not simply fund purchases. It multiplies financial activity. But it also channels a continuous stream of payments toward the institutions providing capital. Over time, this creates one of the most powerful financial flows in the economy: interest moving steadily through the system, which means that every loan is not just a transaction, it is a long-term financial pathway. Money moves forward when the loan is issued, and then gradually moves back through the system as the debt is repaid. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Spending moves money. Debt accelerates its movement. But there is another force quietly reshaping where money ends up: inflation. Most people think of inflation as rising prices. Groceries become more expensive, rent increases, everyday expenses slowly climb higher. But inflation is not only about prices, it is about purchasing power. When the supply of money expands faster than the supply of goods and services, the value of each individual unit of money begins to decline. The same dollar buys slightly less than it did before. The change is gradual, often barely noticeable in the short term, but over long periods of time, the effect becomes significant. This is where the system quietly redistributes financial value. Because inflation does not affect every part of the economy equally. Some prices rise quickly, others rise slowly. Some assets increase dramatically, while wages often adjust much more gradually. This uneven movement creates a structural shift. Those connected to appreciating assets often see their capital rise alongside inflation. Real estate values increase, equity markets expand, physical assets gain nominal value as prices adjust. Meanwhile, money sitting still does not participate in that expansion. Cash savings maintain their numerical value, but their purchasing power slowly declines. This is why inflation behaves like a silent current inside the financial system. It constantly reshapes the real value of money. Over time, the difference becomes visible. Assets rise, prices rise, costs rise. But money that remains static gradually buys less. Inflation also interacts with debt in an interesting way. When prices and wages rise over time, fixed debt obligations become easier to repay in real terms. A mortgage issued decades earlier remains fixed in nominal dollars, but the purchasing power of those dollars declines, which means inflation can quietly reduce the real burden of long-term debt. This dynamic benefits borrowers holding appreciating assets, while lenders rely on interest to compensate for the changing value of money. These movements occur constantly within modern economies. Money expands, prices adjust, assets reprice. But individuals rarely see this full process. What they experience instead are symptoms: higher prices, rising costs, a sense that money does not stretch as far as it once did. Inflation quietly reshapes the destination of money over time, not by removing it from the system, but by gradually altering what each dollar can actually command. Once spending, debt, and inflation are seen together, a clearer picture begins to appear. Money is never static inside the system. It is always moving. Spending pushes it into businesses. Debt accelerates its movement through credit. Inflation reshapes its value over time. These three forces operate continuously. Most people only see small fragments of the process. A paycheck arrives, expenses remove it. Prices rise. Debt payments leave the account every month. From the personal perspective, money seems to appear and then disappear. But inside the system, it rarely disappears at all. It simply changes direction. When you spend money, it becomes revenue for a business. That business pays wages. Those wages circulate through new spending. When debt is issued, credit expands the flow of money forward in time. Borrowers spend. Lenders collect interest. Capital moves through financial institutions. And as inflation slowly reshapes purchasing power, the real value of money shifts across the entire system. Assets reprice. Costs increase. Savings lose a portion of their purchasing power. All of these movements occur simultaneously, quietly, continuously. The result is a financial environment where money is constantly redistributing itself through different channels. Some channels move quickly, others move slowly, but none of them remain still. Understanding this changes how money itself is perceived. Because money is not just a personal tool, it is part of a larger economic circulation. Every dollar interacts with institutions, businesses, banks, markets, and each of those structures redirects the flow in new directions. This is why the question of where money goes is rarely simple. It does not travel in a straight line. It moves through systems designed to keep capital circulating. Spending, credit, investment. The system continuously absorbs money and then redistributes it through new paths. Once that movement becomes visible, financial behavior begins to make more sense. Spending reveals where capital enters the system. Debt reveals how the system accelerates growth. Inflation reveals how purchasing power shifts over time. Together, they form the currents shaping where money ultimately ends up. If this clarified how the system moves money, subscribe. Like this if it shifted your perspective. Most financial advice begins with the same assumption, that money is primarily a matter of discipline. Spend responsibly, save consistently, avoid unnecessary risk. If the behavior is correct, the outcome should improve. This framing turns money into a personal management problem, a matter of habits, choices, self-control. And there is some truth in that. Irresponsible behavior can destroy financial stability. Excessive debt, reckless speculation, chronic overspending. These behaviors create obvious damage. So financial advice often focuses on preventing them. But preventing mistakes is not the same thing as explaining how wealth actually forms inside an economic system. Avoiding damage protects stability. It does not automatically produce expansion. And expansion is where wealth tends to accumulate. This is the quiet limitation of most financial advice. It is designed to reduce harm, not necessarily to explain how the system distributes opportunity. Because the system does not operate primarily on personal discipline, it operates on incentives. Every financial structure contains incentives. Banks lend money because lending generates interest. Investment funds gather capital because management fees grow with assets. Corporations pursue growth because growth increases valuation. These incentives shape how money moves. They influence where capital flows. They influence what opportunities become visible and which ones remain invisible. But everyday financial advice rarely begins with incentives. It begins with behavior. Spend less, save more, be patient. These rules treat the individual as the center of the financial equation. But individuals operate inside a much larger structure, a structure that constantly reallocates capital. Markets expand in certain sectors. Credit becomes easier or harder to access. Asset prices inflate or stagnate. Entire industries rise and fall. These shifts are not controlled by personal discipline. They are shaped by institutional decisions, policy changes, market incentives. And because these forces operate continuously in the background, they influence outcomes far more than most people realize. A person may behave responsibly for years, saving, budgeting, avoiding unnecessary spending. But if the system surrounding them is inflating asset prices faster than their savings accumulate, the gap between discipline and opportunity quietly widens. This is why financial advice built purely around behavior often feels incomplete, not because the advice is wrong, but because it describes only one layer of the system, the personal layer. What it rarely explains is the structural layer beneath it, the incentives that determine where capital flows, the mechanisms that determine how wealth compounds, the structures that quietly reward some positions within the system and slow others down. Understanding those structures changes the entire interpretation of financial advice, because the system is not simply a test of discipline. It is a landscape of incentives, and the outcomes people experience often reflect where they stand within that landscape, far more than how carefully they manage their spending. Once incentives enter the conversation, the system begins to look very different. Financial systems are not neutral environments. They are built around motivations. Banks lend because lending produces interest. Investment firms gather capital because management fees scale with assets. Corporations pursue growth because growth increases valuation. Every institution inside the financial system responds to incentives. Those incentives determine where money flows. They determine which activities expand and which ones remain constrained. This is rarely explained in everyday financial advice. Advice tends to speak in neutral language. Spend responsibly, invest carefully, plan for the future. But the system itself is not neutral. It is structured around financial rewards. Credit expands when lending is profitable. Asset markets grow when capital flows toward them. Entire industries accelerate when investors see opportunity. These movements shape the environment individuals operate inside, long before personal financial decisions even begin. Consider something simple: housing. Housing markets are influenced by far more than individual buyers saving for a home. Interest rates determine borrowing costs. Investment funds allocate capital toward real estate. Developers respond to profit incentives when building supply. All of these forces influence housing prices, often far more dramatically than individual saving behavior. Which means a person can follow responsible advice and still find the environment moving faster than their progress. The same pattern appears in equity markets. Corporate valuations rise when capital flows toward growth sectors. Large investment funds move billions into specific industries. Institutional capital compounds inside the market structure. Individual investors participate in that system, but they do not control its direction. And this is where incentives quietly reshape outcomes. Money moves toward environments where it can multiply, toward systems designed to reward capital. Banks expand lending when it produces reliable returns. Investment funds concentrate capital where growth appears strongest. Corporations pursue expansion because markets reward scale. These incentives continuously reorganize the financial landscape. Yet most financial advice rarely begins with this layer. It begins with budgeting, spending control, savings rates. Important ideas, but ideas that describe behavior, not the forces shaping the environment. Once incentives become visible, financial advice starts to look incomplete. Not incorrect, incomplete. Because discipline alone does not determine financial outcomes. Discipline operates inside a system already moving capital in specific directions. And those directions are determined by incentives far larger than individual decisions. Understanding that shift changes how financial advice is interpreted. Advice becomes guidance for navigating behavior. But the deeper understanding comes from recognizing the incentives that shape the entire system. Because those incentives quietly determine where wealth accumulates and where progress becomes slower. If this feels familiar, if you've felt this pressure but never had words for it, this channel isn't here to motivate you. It's here to help you see clearly. If that resonates, like the video, subscribe. More clarity is coming. Once incentives are understood, ownership. Financial systems reward different positions in very different ways. Some positions require constant effort to generate income. Others participate automatically in the expansion of the system itself. This difference shapes how wealth accumulates over long periods of time. Labor generates income through time, hours worked, tasks completed, value exchanged for compensation. When the work stops, the income usually stops as well. Ownership behaves differently. Assets do not require constant labor to participate in economic growth. They move with the system. A company expands, its equity increases in value. A city grows. Real estate within that city appreciates. Infrastructure produces ongoing cash flow as long as it remains operational. These assets are connected to the expansion of the system itself. They benefit from growth that individuals do not directly control. And over time, that connection begins to compound. Compounding is not simply about saving money. It is about participating in systems that grow. When capital sits inside appreciating assets, the system begins working alongside it. Markets expand. Businesses scale. Cities develop. Each of these forces pushes asset values upward over long periods of time. Not smoothly, but consistently enough to shape the direction of wealth accumulation. This is why ownership becomes such a critical structural layer in financial systems. It connects capital to growth. Labor income, by contrast, often grows slowly. Wage increases tend to move gradually, negotiated, incremental. And in many economies, wage growth has struggled to keep pace with asset inflation. Housing prices rise, equity markets expand, large pools of capital compound. Meanwhile, labor income grows in smaller increments, which means individuals relying only on wages may experience slower financial acceleration over time. This difference does not appear immediately. In the short term, income can feel stable and sufficient. But over decades, the asymmetry becomes more visible. Those connected to appreciating assets move with the expansion of the system. Those relying entirely on labor must continually generate income through effort. This is not a moral judgment. It is a structural observation. Financial systems distribute rewards based on position. Some positions sit closer to capital flows and asset growth. Others remain tied to labor cycles. And once this ownership layer becomes visible, the interpretation of financial advice begins to change again. Saving money remains responsible. Budgeting remains useful. Avoiding reckless decisions remains necessary. But none of those behaviors explain the structural difference between labor and ownership. They describe stability. Ownership explains acceleration. And inside most financial systems, acceleration tends to follow the path of assets connected to long-term economic growth. Once incentives and ownership are very different. Not necessarily wrong, but incomplete. Because most advice is designed for individuals managing behavior. Spend responsibly, save consistently, avoid unnecessary risk. These rules protect stability. They prevent obvious financial damage. They create discipline. But discipline alone does not explain how wealth accumulates inside a system. Wealth accumulation tends to follow structure, incentives, ownership, capital flows. These forces operate quietly in the background. They determine where money moves. They determine which positions inside the system compound faster than others. And once that becomes visible, the entire conversation shifts. Financial advice stops sounding like a full explanation. It starts sounding like an introduction. An introduction to behavior, not an explanation of the system. Because the system itself is not built around personal discipline. It is built around capital expansion. Businesses grow, markets expand, cities develop, new technologies reshape industries. Every one of these processes generates economic value, and that value flows toward positions connected to the system's growth. Assets appreciate as demand increases. Equities grow as companies scale. Infrastructure produces cash flow as long as it remains embedded in economic activity. These dynamics operate continuously, whether individuals notice them or not. Financial advice rarely begins with these mechanisms. It begins with spending habits, savings rates, risk avoidance. Useful ideas, necessary ideas, but ideas that describe how to behave with money, not how the system distributes it. Understanding that difference changes how advice is interpreted. Advice becomes a baseline, a foundation. But the deeper understanding comes from observing the structure surrounding it, where capital flows, what incentives drive the market, which assets participate in economic expansion. Once those questions become visible, financial strategy becomes clearer. Not simpler, but clearer. Because the system does not reward effort alone. It rewards positioning. Positioning within incentives, positioning within ownership structures, positioning within expanding systems. And when that perspective appears, financial advice finally begins to make sense, not as the full map, but as the first layer of understanding. If this shifted how you see the system, subscribe. Like this if it clarified something. Most people believe the solution is simple: earn more money. If income increases, financial pressure should disappear. Bills become easier, savings grow faster, life becomes more stable. And at first, that belief appears correct. A raise arrives, income rises. The next few months feel lighter. There is more room, more breathing space. But something strange happens over time. the pressure returns. The higher income that once felt like relief begins to feel normal. Expenses adjust, expectations rise, lifestyle expands. Soon, the new income stops feeling like progress. It becomes the new baseline. This is the cycle most people experience. They work harder, earn more, feel temporary relief, then slowly return to the same financial tension. The mistake is assuming income was the real problem. In many cases, it wasn't. The problem was structure. Income operates inside a repeating cycle. Work produces money. Money supports life. Life requires more money. The cycle resets again. Higher income improves the cycle. It does not necessarily change it. You can earn twice as much, but if the structure remains the same, the system behaves the same way. More income simply feeds a larger version of the same loop. Expenses rise, obligations grow, the baseline shifts upward. Soon, the higher income becomes required just to maintain stability. This is why many high earners still feel financially constrained. From the outside, their income appears impressive, but internally, their structure has expanded to match it. More money entered the system, but nothing about the system itself changed. This is the first misunderstanding about financial progress. Income alone rarely fixes the underlying problem, because income is only the fuel, it is not the engine. If income is constantly consumed, the cycle never evolves. Work continues, money flows in, money flows out. The system resets. Breaking the cycle requires a structural change, not just a larger paycheck. The real shift begins when income stops being treated as the destination and starts being treated as capital. Capital that can move into ownership, ownership that can begin compounding. Until that shift happens, earning more money may improve life temporarily, but the system will continue behaving exactly the same. Once income increases, a quiet change usually follows. Lifestyle expands. The change rarely feels dramatic. It feels reasonable. You worked harder, you earned more, improving your life seems natural. A better apartment, a newer car, more comfortable travel, better restaurants. Each decision feels small on its own, but together they reshape the structure of your finances. Because lifestyle has a powerful characteristic. It rarely moves backward. Once a higher standard becomes normal, it becomes difficult to reduce. Expectations adjust. Habits form. Expenses stabilize at the new level. Soon, the new lifestyle becomes the baseline. What once felt luxurious now feels ordinary. This is how income increases quietly disappear, not through mistakes, through expansion. More income allows more consumption. More consumption raises the cost of maintaining life, and once the cost rises, income must continue rising to support it. This is the second structural reason higher income doesn't solve the problem, because the system adapts. Expenses expand to meet income. The gap that once existed between income and obligations begins to close again. Savings slow. Investment capital shrinks. Financial pressure quietly returns. From the outside, the person appears more successful. Their income increased. Their lifestyle improved. But their financial flexibility may not have changed. Flexibility is the hidden ingredient of financial progress. It allows capital to accumulate. It allows patience. It allows investment during uncertain moments. Lifestyle inflation reduces that flexibility because more income becomes required just to maintain stability. Income becomes maintenance instead of leverage. This is why the belief that higher income fixes financial problems is incomplete. Income creates opportunity, but opportunity depends on what happens next. If income flows entirely into lifestyle expansion, the cycle continues. Work produces money. Money supports a larger life. A larger life requires more work. The structure remains unchanged. Real financial progress requires a different direction for surplus, not toward consumption, toward ownership. Ownership is what changes the system. Ownership introduces compounding. Compounding creates acceleration. Without ownership, income must keep growing forever. With ownership, income begins building something that grows on its own. And that is the difference between earning more money and actually changing the structure of your financial life. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Even when people recognize that income alone isn't solving the problem, another force quietly keeps the cycle in place. Obligations. As income rises, life expands. A larger apartment, a newer car, a longer list of monthly commitments. At first, these upgrades feel earned. They feel like the reward for working harder. But every upgrade carries something else with it. A fixed cost, a recurring payment, a new baseline that must be sustained. Once obligations increase, income stops feeling like progress. It becomes maintenance. Maintenance of the house, maintenance of the car, maintenance of the lifestyle that slowly formed around the higher paycheck. This is where the structure tightens. Higher income should create freedom, but obligations quietly reduce it. Because every fixed expense converts future income into a requirement. Part of next month's paycheck is already spoken for. Part of next year's effort is already committed. Over time, the paycheck becomes less flexible, not because the income is small, because the structure around it is heavy. This is why people earning far more than they once imagined can still feel financially trapped. From the outside, the income appears impressive, but inside the system, most of that income is already allocated. Bills, payments, lifestyle maintenance. The paycheck arrives and immediately disperses. Not through mistakes, through commitments. And commitments create gravity. Financial gravity makes movement difficult. When obligations are high, risk tolerance drops. Waiting becomes harder. Investing becomes uncomfortable. Because stability must be protected. Income must continue. The structure depends on it. This is where the belief that more income will solve everything quietly breaks apart. Income can increase dramatically, but if obligations increase alongside it, the financial pressure remains. The system resets, again, and again, and again. Each time income rises, life expands to match it. Each expansion increases the cost of maintaining stability. Each new cost strengthens the dependency on the next paycheck. This is how many people become permanently tied to income cycles, not because they failed, because the structure reinforced itself. Income alone rarely changes that structure, because income flows through the system. Ownership changes the system. Ownership redirects income into assets. Assets behave differently than expenses. Expenses consume money. Assets produce it. The difference seems small in the beginning. A little less consumption, a little more allocation, a small piece of ownership somewhere inside the larger economy. But ownership introduces something income alone cannot create: compounding. Compounding allows capital to grow beyond effort. It allows returns to produce more returns. It allows time to begin working inside the system. This is the moment when the financial structure begins to shift. Work still produces income, but income no longer disappears entirely into obligations. Some of it begins building assets. Those assets accumulate quietly. They grow slowly at first, but over time, they begin carrying weight. And when assets begin carrying weight, the paycheck is no longer the only engine of progress. Money begins moving independently of effort. This is why making more money alone rarely fixes the problem, because income improves the cycle, but ownership changes it. Without ownership, income must always keep rising to support life. With ownership, life slowly becomes supported by the systems you helped build. And that is the structural difference most people eventually discover, not between low income and high income, but between income alone and income that builds something beyond itself. By the time many people realize the pattern, they have already experienced it several times. Income rises, life improves, pressure disappears. Then, slowly, the pressure returns. At first, it feels confusing. You are earning more than you did years ago. You are working harder. You are progressing. Yet, financially, the system still feels tight. The reason becomes clear once the structure is visible. Income alone cannot solve a structural problem. Because income flows through the system. It enters, it supports life, then it leaves. The cycle resets. Work produces money. Money supports obligations. Obligations require continued work. Higher income improves the cycle, but it rarely changes it. This is why the strategy cannot stop at earning more. Earning more simply increases the amount of fuel entering the system. But fuel without an engine does not create acceleration. Ownership is the engine. Ownership redirects income into assets. Assets behave differently than expenses. Expenses disappear, assets remain. Assets grow, they produce returns. Those returns produce additional returns. Compounding begins operating quietly in the background. At first, the change is small. A little less consumption, a little more allocation, a small piece of ownership somewhere in the larger economy. Over time, the structure begins shifting. Income still arrives, but now some of it is building something that does not reset every month. Ownership begins carrying weight. Assets begin contributing to progress. Work is no longer the only engine. Eventually, the difference becomes visible. One life continues depending entirely on income. The other begins accumulating leverage. Leverage changes how money behaves. Income becomes optional fuel. Assets become the system producing momentum. This is the shift most people eventually discover. The real problem was never the paycheck. It was the structure around it. Once income begins building ownership instead of only supporting consumption, the system stops resetting, and progress begins compounding. If this changed how you see money and income, subscribe. Like this if it clarified something. From a young age, most people are taught a simple rule: work hard, study harder, work longer, outperform everyone around you, and eventually, success will follow. This message is repeated everywhere: schools, careers, society. Effort becomes the central idea. Hard work is presented as the entire strategy, not the beginning of one. And to be clear, effort matters. Nothing meaningful happens without it. Work builds skills. Work builds discipline. Work creates income. But effort alone does not build wealth. It creates the starting point. Because effort operates inside a linear system. You trade time for money. 1 hour, one payment. More effort creates more income, but the structure remains the same. Your progress depends on continued effort. If the effort stops, the income stops. This is the structure most people live inside. Work produces income. Income supports life. Life requires more income. The cycle repeats. For many people, the cycle works well enough. Income grows over time. Promotions appear. Responsibilities increase. But the structure never changes. You improve your position inside the system. You rarely change your relationship with it. This is where the misunderstanding begins. People believe the solution is more effort, more hours, more discipline, more productivity. But effort has limits. There are only so many hours in a day, only so much energy in a career, only so many promotions available. Eventually, every effort-based system encounters the same ceiling: time. Time limits effort. Time limits income. Time limits progress. Meanwhile, something else exists inside the financial system: ownership. Ownership follows different rules. Effort produces income. Ownership produces leverage. Leverage changes scale. A worker produces value through time. An owner produces value through systems. Those systems can operate continuously. Businesses grow. Assets appreciate. Markets expand. Ownership allows one decision to influence thousands of outcomes. This is where the strategy begins. Work builds the capital. Capital builds ownership. Ownership builds leverage. But most people never move beyond the first step. They work harder, earn more, improve their lifestyle, and remain inside the same structure. Hard work was never meant to be the entire strategy. It was meant to be the beginning, the entry point, the phase that produces the resources needed for the next move. Because the real shift happens when effort stops being the only engine of progress, when income becomes fuel, and ownership becomes the machine. That is when money begins behaving differently, not because you stopped working, but because work finally started building something that compounds. Once you understand that effort is only the beginning, the next question appears: why doesn't effort scale? People often believe that working harder should eventually produce extraordinary results: more effort, more hours, more responsibility, more income. And for a while, this seems true. Early in a career, effort produces noticeable progress. Skills improve, income rises, opportunities expand. But the structure remains linear. Linear systems move step by step. You add more effort, you gain slightly more output. The relationship stays proportional. More work equals more income. But the increase is always tied to your time. This is the hidden limitation of effort. Time cannot multiply. It can only be divided. You can extend work hours slightly. You can increase productivity. You can take on more responsibility, but eventually the same constraint appears. There are still only 24 hours in a day. This is where most people reach a plateau. Not because they lack discipline, because the system itself cannot accelerate. Effort produces steady growth, but steady growth is not exponential growth. Exponential systems behave differently. They start slowly, almost invisibly. Then they accelerate. Ownership exists inside exponential systems. Assets grow, businesses scale, investments compound. One decision begins influencing outcomes far beyond your personal effort. A company grows from 10 employees to 1,000. A single investment grows year after year. A piece of property appreciates over decades. Those outcomes do not depend on your daily hours. They depend on the system continuing to operate. This is the difference between labor and leverage. Labor produces value through effort. Leverage produces value through structure. Structure allows progress to continue without constant input. Effort requires continuous input. That distinction is the dividing line between income and wealth. Income requires work. Wealth requires ownership. Effort will always matter. Work builds skills. Work creates opportunity. Work generates the capital that makes ownership possible. But effort alone can never close the gap created by leverage, because leverage multiplies outcomes. Effort only adds to them. A worker may increase income steadily for decades. An owner may experience uneven progress early. But when leverage begins to operate, the curve changes. Returns build on returns. Systems expand. Growth begins feeding itself. At that point, effort is no longer the primary engine. Ownership becomes the engine. This is the moment most people misunderstand. They believe hard work should produce the same scale as leverage, but the structures are different. Linear systems and exponential systems. One grows through effort. The other grows through compounding. And the strategy of wealth begins when someone stops asking, "How can I work harder?" and starts asking, "How can my effort build something that scales?" Before this continues, if you felt seen instead of sold to, that's the entire point of Relentless Wealth. Like the video, subscribe. We're just getting started. Once someone understands leverage, a second question appears. If the system rewards ownership, why do most people remain inside labor? The answer is not intelligence. It is structure. Labor produces immediate reward. You work today, you are paid this week. The feedback is fast, clear, reliable. Ownership behaves differently. Returns arrive slowly. Growth appears inconsistent. Progress is often invisible in the beginning. This difference shapes behavior. Humans respond strongly to immediate results. When effort produces instant income, the brain reinforces the pattern. Work more, earn more, repeat. Ownership rarely produces that same feedback early. You invest, nothing dramatic happens. Months pass, sometimes years. Growth remains quiet. This phase discourages most people because it feels inefficient compared to labor. Labor produces visible reward. Ownership requires patience. And patience is difficult inside a system that constantly rewards activity. Work harder, produce more, stay busy. The system celebrates motion. Ownership often looks like the opposite: waiting, holding assets, allowing time to operate. To someone trained inside labor systems, this can feel uncomfortable, even irresponsible, because effort feels productive. Stillness feels uncertain. So many people continue prioritizing effort, even after they intellectually understand ownership. They increase income, expand lifestyle, improve stability. But stability can quietly reinforce the labor cycle. Higher income supports higher expenses. Higher expenses require continued effort. The cycle strengthens. This is why the transition from labor to ownership rarely happens automatically. It requires a deliberate shift. Income must be redirected. Surplus must be preserved. Capital must enter ownership systems. businesses, markets, assets, structures that continue producing value without constant effort. At first, those structures are small, a modest investment, a small stake, a piece of ownership inside a larger system. But compounding does not require large beginnings. It requires duration. The longer ownership exists, the more leverage expands. This is where patience becomes strategy. Labor provides the fuel. Ownership builds the engine. Over time, the engine becomes more powerful than the fuel itself. Eventually, something subtle begins to change. Income is no longer the only source of progress. Assets begin contributing. Returns begin stacking. Growth begins feeding itself. This is when the relationship with work shifts. Work is no longer the entire system. It becomes one component inside a larger structure. The labor cycle begins to loosen. Ownership begins carrying more weight, and money begins moving in ways effort alone could never produce. Even when people understand leverage, most still remain inside the labor cycle, not because they lack ambition, because the system quietly rewards stability. Stable income, stable routines, stable expectations. These things create order. They reduce uncertainty. They make life predictable. Predictability feels safe, and safety is powerful. When income is consistent, the pressure to redesign your structure fades. Instead of asking how to escape the cycle, most people focus on improving their position inside it. A promotion, a higher salary, a slightly better lifestyle. All of those feel like progress, and in many ways they are. But the underlying structure stays the same. Work produces income. Income sustains life. Life requires continued work. The cycle continues. Ownership disrupts that cycle, but ownership introduces uncertainty. Assets fluctuate, markets move, businesses evolve. For someone accustomed to stability, that uncertainty can feel uncomfortable. So the safer path becomes more effort, more stability, more predictability. Over time, stability becomes dependency. Income must remain consistent to maintain the structure of life. Obligations increase, expenses rise, risk tolerance shrinks. And when risk tolerance shrinks, ownership becomes harder to pursue, because ownership requires patience through uncertainty. This is how the labor cycle quietly sustains itself. Income increases, lifestyle expands, ownership remains delayed. Delayed ownership delays leverage, delayed leverage delays compounding, and delayed compounding delays freedom. None of this happens dramatically. It happens gradually, year by year, decision by decision. Choosing stability over uncertainty, choosing lifestyle over surplus, choosing effort over leverage. Each decision feels reasonable. Each decision preserves the present, but together they reinforce the cycle. This is why understanding the system is not enough. Strategy requires action. Income must eventually move beyond consumption. It must become capital. Capital enters ownership. Ownership builds leverage. Leverage changes scale. At that point, the structure begins shifting. Work still matters, but it is no longer the only engine of progress. Assets begin contributing. Compounding begins operating. And slowly, the labor cycle loses its control, because ownership has begun carrying the weight effort once carried alone. Hard work was never the mistake. It was the beginning. Work builds discipline. Work builds skill. Work produces the income that allows everything else to happen. But the system was never designed for effort alone to produce wealth. Effort produces income. Ownership produces leverage. Those two forces operate under different rules. Income depends on time. Ownership depends on scale. When your progress depends only on effort, your progress will always move at the speed of time. But when ownership begins to compound, progress accelerates beyond time. That is the moment the strategy changes. Income stops being the destination. It becomes fuel. Fuel for assets. Fuel for ownership. Fuel for systems that continue producing value without constant effort. The transition rarely happens suddenly. It begins with small decisions, redirecting surplus, owning small pieces of productive systems, allowing time to begin working on your behalf. At first, the difference is almost invisible. Two people work hard, two people earn similar incomes, two people appear equally successful. But one structure relies entirely on effort. The other slowly accumulates leverage. Over time, leverage changes everything. Assets begin producing returns. Returns begin compounding. Growth begins feeding itself. Eventually, something subtle happens. Work stops being the only engine of progress. Money begins moving independently of daily effort. That is when the system starts behaving differently. You are no longer only participating in it, you are accumulating influence inside it. Hard work still matters, but it is no longer the strategy, it is the entry point, the phase that creates the resources needed to build something that scales. Work builds the capital. Capital builds ownership. Ownership builds leverage. Leverage builds freedom. That sequence is the strategy most people were never shown. But once you understand it, the financial system stops feeling random. It begins to look structural. And structural systems can be navigated. If this changed how you see work and money, subscribe. Like this if it clarified something.